Welcome to the Deep Dive.
Good to be here.
Today we're jumping into the first quarter fiscal 2026 earnings call for Yext Inc. That's ticker YEX.
Right. And the big headline right off the bat, management called it a very strong Q1.
Yeah, very strong. They said they outperformed their own guidance on, well, basically everything, all metrics.
And they see that strength continuing into Q2. That was the clear message.
So not just meeting expectations, but actually beating them and feeling good about the near future.
Exactly. So in this deep dive, we're going to unpack what they pointed to as the reasons behind these results, what's driving it.
And also their view on the market, their strategy. Let's get into it.
Okay, so first up, management spent a good chunk of time talking about the market itself. What's happening out there?
What was their main point?
Their central idea is this. Consumer search is fragmenting, and it's accelerating.
Fragmenting, meaning not just Google anymore.
Precisely. It's not just the traditional search engines. They specifically called out the advancements in AI search. Think conversational AI, specialized tools.
Like chatbots giving answers or searching within specific apps.
Exactly that. It's dispersing how people find information about businesses. It's happening in more places, often through these new AI interfaces.
Okay, so search is getting scattered.
Right. And management argues this makes things much more complex for brands, which they say significantly increases the importance of actively managing your digital visibility across all these different spots.
So this fragmentation, they don't see it as a problem for Yext, they see it as a plus.
That's definitely their take.
Yeah.
They argued, pretty compellingly, I thought, that this fragmented environment actually makes their core products more valuable.
How so?
Well, things like managing listings, reviews, website pages, social presence. If consumers are looking everywhere, you need to be accurate and visible everywhere. It becomes mission critical.
Makes sense.
And they also feel it creates fertile ground, I think was the phrase, for new products.
Right, like Yext Scout, which we definitely need to dig into.
Absolutely.
But sticking with the core business health for just a sec. They mentioned internal improvements, too.
Yeah, they did. They noted improvements in key areas. Things like gross and net customer retention rates were up.
Okay.
Customer satisfaction scores were better. And just the general feeling from customers about the value they get from the platform seems stronger.
And how does that connect back to the messy, fragmented market?
Well, their argument is, in this complex world, just having a presence isn't enough. You need an effective, comprehensive one. And they believe their platform is, best in class for that. So management feels this actually reduces the pressure from cheaper, maybe simpler competitors.
Because getting it right across all these channels is harder and more important.
Exactly. The stakes are higher. So they feel their more advanced products gain traction because the market's getting complicated, not despite it.
Interesting. So a quality guide is more valuable in a maze, basically.
That's a good way to put it.
Okay, so we have this improving core health, a market trend they like. How did that translate into the actual Q1 financial beat? What were the specifics?
They mentioned a couple things. Part of the upside in revenue and direct ARR got a bit of a tailwind from FX rates.
Foreign exchange.
Yeah, specifically the pound strengthened, which helped offset some headwinds they'd seen before. But the bigger piece, the more sustainable driver they pointed to.
Let me guess, retention.
You got it. Continued improvement in customer retention rates.
Right.
Better retention flows right through to that recurring revenue.
Okay, that makes sense. Now, thinking about the future. Yext Scout. Management sounded really genuinely excited about this.
Oh, definitely. The enthusiasm was noticeable in the call.
What did they say about the initial reaction?
They highlighted a wait list right away. 1,000 potential customers.
1,000. Wow.
Yeah, and the mix was interesting. Existing customers, totally new prospects, and big enterprise brands. They said recent demos starting around early April really drove that interest.
1,000 is a strong signal. But is it fully launched? Available now?
Not full general availability yet. They're still in beta. It started really small, fewer than 10 development partners.
Good.
But more recently, they moved to what they called an open beta. And they gave a specific number. Just in the 48 hours before the call, they added another 37 customers to the beta.
37 in 2 days? That's moving.
Yeah, bringing the total live beta users to around 45 at the time they spoke.
Okay, 45 beta customers. What's the feedback been like?
They reported, and I quote, amazing feedback. Also, very high value perception.
Amazing is strong language for an earnings call.
It is. They even use this phrase, a 0% disinterest rate, from customers who've seen it.
0% disinterest.
Now, obviously, that's from a small beta group. We need to see if that holds up as they scale.
Sure, early days, but still a powerful initial sign.
Definitely. And the value proposition they laid out for Scout, it gives customers over 150 metrics, but crucially, they're non-performance metrics.
Non-performance, so not just clicks and conversions.
Right. It's about understanding your visibility, your competitive position across all these different channels. How are you really showing up?
Okay, I think I see where this is going. How does Scout connect back to their existing stuff lists, listings, reviews, pages? Does it reinforce those?
That's exactly the strategic angle they pushed. Yeah. Scout provides this detailed visibility data, often down to a specific store level for big brands.
Right.
And it can show the customer how using Yext's core tools, keeping listings accurate, managing reviews, optimizing pages actually impacts their visibility compared to competitors.
Ah, so it's like proof. It shows the ROI of the main platform.
Exactly. It's a data-driven validation. It demonstrates how the core Yext suite helps you win in this fragmented AI-driven search world.
Which helps fight off that idea that these services are just commodities.
Precisely. It elevates the discussion. It's not just managed listings, it's win on visibility. And here's the data showing how our tools help you do that.
Okay, smart. What do they see as the long-term potential for Scout?
They think it could be a pretty significant growth driver. They talked about TAM expansion, total addressable market.
Because it addresses a broader need than just presence management?
Right, visibility monitoring. And they see chances to sell it standalone or attach it to existing deals. Lots of possibilities.
Is it going to be a long sales cycle to get this adopted? It sounds potentially complex.
Interestingly, they were optimistic about a potentially shorter sales cycle than some other products.
Really? Why?
Their reasoning was implementation is fairly easy. A lot of the data is public web data, and the value is clear and immediate given how complex the market is right now. Brands need this visibility now.
Makes sense. Any timeline for full launch? General availability?
No specific date given yet, but they sounded confident they could roll it out widely once they're happy with the beta results.
Okay, so Yext Scout is clearly a big bet for navigating this new landscape. Let's shift gears slightly to their overall financial strategy. They sounded positive, but the full year guidance was still kind of cautious.
Yeah, they struck a balanced tone there, acknowledged the strong Q1, the momentum, but pointed to ongoing, macroeconomic uncertainty.
It's being prudent.
Seems like it. Balancing their internal optimism with the reality that the broader economy could still throw some curveballs later in the year. Impact spending, decision cycles, that kind of thing.
Makes sense. So how are they planning to use their cash and balance sheet? Capital allocation came up.
It did. They talked about both share buybacks and M&A.
Okay.
On buybacks, they actually ramped up the pace in Q1 and kept going in May. Management said explicitly they see the stock as a great investment right now based on its EBITDA multiple.
So buying their own shares.
Yeah, the stated goal is anti-dilution. They pointed out they've already reduced the share count over the last 3 years doing this.
What about M&A? Buying other companies, is it one or the other?
They framed it as not necessarily either or. They think the current market might actually create some good opportunities for opportunistic deals. Highly accretive acquisitions was the term. They seem happy with recent deals like Hearsay and Place Scout and said they'll stay disciplined, but having financial flexibility lets them look at both buybacks and deals.
Right. And speaking of financial flexibility, they announced this new debt facility with BlackRock. What was the thinking there?
Well, the immediate reason was practical. Their old credit line with SVB was expiring at the end of the year.
Ah, okay. Had to replace it.
Yeah, they need it for basics, like backing letters of credit for office leases. But the strategic angle with BlackRock is bigger.
How so?
They see it giving them more confidence, more flexibility. The terms, the covenants in the new deal are apparently better suited for their current size.
Meaning they can do more?
Potentially, yeah. It gives them more agility to chase larger growth initiatives, maybe a bigger M&A if the right opportunity comes along, compared to what the old facility allowed.
So it's not just keeping the lights on, it's upgrading the wiring for future potential.
Exactly. Covers the necessities, but also provides strategic optionality.
Okay, so we've hit the strong Q1, the view on the fragmented AI market, the excitement around Yext Scout, the capital allocation thoughts, and this BlackRock facility. Let's move into our little speculative segment.
Right. And let's be crystal clear again. This is absolutely not financial advice.
Definitely not. Purely a thought experiment.
Just playing with the themes and ideas management brought up on the call. How could someone theoretically react in the market based on this narrative, only for illustration?
Got it. Not a recommendation. But okay, based on the themes, strong finances, M&A potential boosted by BlackRock, Yext Scout maybe driving growth and fighting commoditization, plus management's conviction about AI fragmenting search. What's an outrageous but plausible trade idea? Just for fun.
Well, you could imagine someone constructing a really complex play. Maybe taking a long position in a custom volatility swap, specifically targeting Yext's future earnings announcements.
A vol swap.
The theory would be, if Scout really takes off after general availability, or if retention keeps surprising to the upside, the market reaction around those future news events could be much bigger, much more volatile, as investors really buy into this AI-era positioning story.
Okay, betting on bigger swings around news.
Right. And then maybe to hedge that, or maybe to lean even further into the fragmentation idea, you could pair that long vol swap with a short position.
Sure what?
Maybe a theoretical basket of smaller digital visibility companies, maybe ones that seem less technologically advanced, less integrated.
The little guys.
The speculative logic. If Yext, with Scout and its platform, really does grab share and pricing power faster than expected in this messy market,
then those smaller players could get squeezed.
Exactly. They might face more competition, faster commoditization. Again, highly speculative, needs sophisticated tools.
And purely hypothetical.
Absolutely. Just connecting the narrative dots from the call into a potential theoretical market strategy.
Fascinating to think through the potential ripples.
It is.
Okay, let's bring it back to what was actually reported. To recap, Yext started fiscal 26 strong, beat guidance. They see big opportunities in this fragmenting digital market driven by AI search.
Huge enthusiasm for the early signs from Yext Scout customer interest, perceived value.
And strategically, they're using their financial strength, buying back shares, but also setting up for potential future growth and M&A with that new BlackRock facility.
That sums up the key messages from management. A company feeling good internally and believing the external trends are moving in their favor.
And one last time, this deep dive was just us unpacking the earnings call. It's absolutely not financial advice.
Not in any way, just discussing the information management shared.
So for you, the listener, maybe chew on this. That core idea of AI fragmenting search and discovery. If that's really happening, if finding information gets truly decentralized,
Yeah.
how does that change everything for businesses trying to be seen online?
Is this just a temporary blip or a fundamental shift? And what does that mean for all the players in the digital visibility space, not just Yext?
Something to definitely keep an eye on.